Stock skeptics say a $6 trillion cash hoard waiting on the sidelines is a mirage or a fantasy. Record cash hoard may not completely be recycled into risk assets. Those are things like stocks and bonds. So this weekend, we're going to talk about the big fail that happened only after a week. Last weekend, we talked about how it was really important for us to maintain this 470 area, and we closed below it. So below 470 is bad. Over 480 is good. And the reason why this matters is because we could potentially be going down as low as 378 on the annual chart, which would be pretty scary. We note here that on the weekly chart, we're now getting two signs of a warning and then early confirmation. So we're going to talk about what confirmation would look like this week. We're also going to talk about the exact same thing on QQQ, where we have number one, a warning, number two, early confirmation. And then looking at the heat map, it's been a pretty bloody week. Lots of names selling off pretty hard. Apple, Amazon, Tesla, a lot of the big gainers from last year. And we're still in greed. We've only slipped down by about 1 point. So things look a little bit funky. And then the headline of the video also says that there is a 62% chance this happens next. It's the odds of a March rate cut, what the Federal Reserve would be expected to do. And then as a quick preview for the rest of the show, what I also want to go through is I have another card laid out here like I did for Apple. And what I'd like to do is go through a couple of screenshots to illustrate a story. But here are the best little bits. We're going to dive into each one of these portions a little bit later in the show. So please make sure you stay tuned for the whole portion. The overview is that where will the $6 trillion go? Is it going to go to bonds, stocks, or the money market? Well, we don't know. So we're going to try to look for evidence in terms of where that could happen. 62.3% chance of a March rate cut. The banking crisis timeline, Bear Stearns and Fannie Mae and Freddie Mac. Yeah, this one's a little bit scary. Then we can also talk about the list of banking crises because we have bank earnings kicking off this week. Yep, that's right. Bank earnings kick off. We'll also talk about algos, which are giving us a lot of inverse signals. It's giving us a buy signal for the dollar, a buy signal for inverse treasuries, inverse Russell, and now we're due for inverse S&P 500, Dow Jones, and also ARK. It's looking pretty bleak out there. Also, our annual levels for the S&P are now flashing a bearish signal. We note that here by what we just went through. We're also looking at a neutral number for the monthly because we've now fallen below that 470, and we can note the levels right here. So we'll come back and do some charts a little bit later on the S&P. Same thing for QQQ. It's red on the annual, it's yellow on the monthly, and we got some key areas. We got the 10-year note, we got the dollar, we got the VIX, and we got the Mag 7. So there we go. That's the quick preview for today. I've put a lot of effort into today's video, so what I would really appreciate is if you could please consider smashing that thumbs up and subscribing to the channel, because these videos are really possible because I have an audience like you, and I'm really grateful that I have a chance to do this every single day. So thank you very much. All right, let's jump back into the story here. So we talked about a 62% chance of a rate cut, and that's pretty significant. So what is causing the market to move? Because after we got this December U.S. jobs report on Friday, we actually saw this number tick higher. We were only at 56, and the market actually sold off more on Friday. It actually went down. It actually closed up by 0.14. So because the market closed up, it's because this odds of a rate cut actually increased by about 5 or 6%. But we want to think about whether or not Jerome Powell is going to agree with these numbers, because average hourly earnings at a month over month at 0.4 is not good. Unemployment rate is really sticky. This is a strong labor market. And the concern here is that on a year over year, average hourly earnings are over 4%. Remember, the Fed's target is 2. 4 is bigger than 2. It's 100% higher. And finally, this is a concern because if we think about the concerns the Fed has going back to 1970s, they're worried about a wage price spiral, which is exactly what that data kind of illustrates, the potential for it. In terms of economic data for this week, we have number 1, 2, and 3 significance. Number 1 is going to be that CPI report coming out on Thursday here. Then number 2 is going to be the 10-year note auction. We talked about the 10-year note. We got some technical levels to look at. And then finally, we get PPI, or Producer Price Index, coming out on Friday. So all those are really going to help tell the story. Short sellers have added more contracts. So they're now here over 200,000 contracts short. So they held the line. They're bearish. This will also be important because we have bank earnings really kicking off on Friday. And again, I teased out that portion regarding the bank crises. So we got JP Morgan, we got Wells Fargo, Bank of America, Citigroup, and BlackRock all reporting on Friday. And then in terms of other upcoming bank earnings, we can look forward to the next week. Morgan Stanley, Goldman Sachs, those two will be really important. They're big dogs. JP Morgan's going to likely set the tone, though. And then more smaller bank earnings. Again, that SVB issue we had earlier in the year, we're going to talk about that. So that's it. So let's just quickly talk about SVB, because we note that it was actually March of 2023 where we had this issue. We're almost on the anniversary, almost 1 year later. And ironically, today is 3 years after January 6th. So we'll see whether or not America is still supreme and whether or not America is still the best game in town. I say this because it's now a year later after the SVB crisis. And when we look here to something I shared back in April of 2023, I'm like, well, this looks awfully familiar. Bear Stearns was 6 months after. Bear Stearns, if we look here to the dates, Bear Stearns happened. And then 6 months later, we have Fannie Mae and Freddie Mac collapsing. That's the banking crisis that happened here. So a year after SVB, I don't know what's going to happen. But what I do know is that there was a big timeline for it. And because we have all these big bank earnings reporting first and then smaller caps reporting second, I am very, very receptive to the fact that the market just failed. So that's the preview for so far. Let me see what I have for my notes here, and then we will see what else we have to go through here. So is there any more detail I need to give to these? No. $6 trillion. So everyone thought that this money was going to flow back into stocks. But as like so far this year, if we look at year to date, it's not working. Everything's red. And generally, the first 5 calendar days of the year signify where the stock market is going to go for the rest of the year, the first 5 days. And if we look to the first 5 days, it's awfully bloody. And this matters because when we look here to our annual chart, well, this is a really bad omen for what happened in 2024, where, man, we just went straight down. That's not good. So it's not really telling us that the market has a lot of rotation. There is net selling. If there was rotation, we would see that clearly by more blocks being green or being greener. Eli Lilly's pretty green again. They got that obesity drug. Merck, Johnson & Johnson doing okay. But Apple, Amazon, and Tesla are pretty big blocks. The biggest stocks in the S&P 500 are largely red. NVIDIA's treading water. Otherwise, we're looking for everything else. But overall, when we just visually look at here, it looks red. And that's the reason why the market's down so far this year. So it doesn't look like stock skeptics are going to be recycling those dollars, the $6 trillion, into the stock market, at least not for right now. So if they're not going to put their money there, where could it go? Well, it could go to the bond market. We'll look at that chart a little bit later. It could go into the money markets, which is where it's sitting right now. And that would be bad. It would be bad for stocks bad for banks because as their deposits go down, it means that they have less assets. As they have less assets, another SVB crisis could become more evident. Why? Because they're called reserve ratios. So a bank has to hold a certain portion of reserves as a guarantee. And if their unrealized losses for bonds continue to climb, which was the exact issue at SVB, that would cause a much wider systemic issue, kind of like what happened in 2008. This was terrible when it happened, by the way. So we talked about the stock skeptics. We now understand that as an overview, we have to really pay attention to bank earnings this week, which only really kick off on Friday. So what's going to happen before Friday? Well, we're going to get 10-year note auction. That's going to really matter. Again, we'll look at those charts a little bit later. We're going to get CPI. So is inflation reaccelerating like we saw earlier this week? And then finally, producer price index is a leading indicator or a preview for what CPI would be in February. Okay. This all makes sense so far, and let's go down to the next section, algos. So what does this say? Well, let's look at the charts here because what our system is saying is that the dollar is set to go higher, and right now the dollar is actually looking pretty bullish. Why do I say that? Well, look, it's pointing up. So pointing up is bullish. That's an uptrend, and we note that we're running a test here to the 50 MA, and if we claim it, this could actually catapult a lot higher. We're still below resistance here, which I call about 106.50. And this goes all the way back here to our high that we established going back in 1980, 1989. I was 1 year old at that time. It acted as pretty good resistance for some kind of head and shoulders over here. And then we didn't quite make it here. So if the dollar is going to break out, we first of all have to claim the 50 MA. And then if we do that, we can run a test back up to 106. That would be the level I'm looking for here. If we jump down to the dollar notes, 50 weekly moving average is likely going to get tested next week because it's rallying. Okay. Then if you look here to our monthly chart, whoa, well, this looks like pretty bullish too. Yeah, this is scary. It's scary because if the dollar goes up, the rule of thumb is that stocks go down. So right now, the dollar's saying, "Hey, I think I'm ready to go up." When I look at the chart, I'm like, "Whoa, that's like giving me the creeps." So the dollar was due for an invest alert. That means the weekly chart, but it just missed it by about 0.25% this week. If we now look forward to TBF, which is inverse the 20-year note, this one popped off this week, and it looks pretty strong as well. And the reason why it looks strong is because it's actually reapproaching this 50 weekly moving average here. And if it claims that, that's like pretty bullish. I'll give you one more chart here, which is the 10-year note. And the reason we'll look at this one is because the TBF is inverse 20-year. Here we're looking at the 10-year Treasury note, which is the risk-free return. And we're going to have an auction for this one later this week. So that 10-year note auction is going to happen on Wednesday. That's the first most significant data point we're going to get this week for potentially high volatility. So if I go down here to my US 10-year note notes, it tells us that we've now breached the 200 DMA. We're over the 50 weekly moving average. It also broke the channel, and we had that TBF invest whisper. So what exactly does that mean? Let's go to the daily chart first. So we poked over, right? We breached, we violated, we poked over this black line, which is the 200 average, which means that it's trying to reclaim the one-day chart long-term price. One more time. It's trying to reclaim the one-day chart long-term price. That could be a long-term trend because we've been going down. If we curl back up, that would be bad for stocks. On the 10-year note weekly chart, again, now we're going to check off that 200 DMA breach. If we look here to the 50 weekly moving average close over and also broke the channel. Those are the two notes. So if we now go here, let's delete everything. That same blue line is a short-term price, or the 50 MA. That's at 3.98. Well, we closed over. We got to 4.05. That psychological number did get breached and violated, which means we're over it. And secondly, we also note that when we open up next week's candle, we're going to be over the downtrend, which has been a very, very reliable pattern for us to go stair-step lower, stair-step lower, stair-step lower, stair-step lower. And again, I know we haven't gone through the S&P 500 and the NASDAQ yet, but again, I have the notes right here. We're going to go through those, so please make sure you stay tuned till the end. And then finally, we got that TBF Invest Whisper. So if you're familiar with our system, the algo, what it means is that we got the whisper this week. We're due for continuation next week. That's our algo alert. So we think bonds are going to go up. That's what our system says. The Russell 2000 inverse. While I talked about this one extensively this week. I put that trade on that I showed you as well. And we got the whisper coming in on Friday, which held. And we're also due for continuation next week because we have that invest alert due. Not only do we have the dollar, bonds, the Russell 2000 giving us bearish signals, we now also have SH, which is due for an invest algo. That's inverse the S&P 500. So what it's saying is that it thinks the S&P 500 is going to go down because this line's going to go up. So what we talk about often on this channel is the curl. So we go down, get a curl, we go up. 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 Go down, get a curl. Are we about to go up? Well, our system says it's giving us all the indications that if it does, it's real. So the S&P 500 looks a little bit bearish. Apply that same thinking to the Dow Jones, or dog, and then to SARC, which is short arc. So everything's saying it's time for us to go down. And I'm going to ask you one more time, please and thank you, to please consider smashing the thumbs up and subscribing to the channel, because this is part of my paid system that I would normally not share with YouTube, but I feel the need to share this bearish story because I don't think people are legitimately prepared for what could come next. All right, now let's move forward. We got the S&P 500. So when we look here to the chart we shared before, under 470 is bad. We're currently at 467. That's bad. Okay, cool. Annual levels done. We're now going to move forward to the monthly. So if we look here to our monthly chart, we're going to go to SPY, pop over to the third board, which is our monthly here. And what do we note? Well, we note that we have 4 levels here. We got a lower low, we got 2 pivots, and we have an all-time high. Okay, cool. So if we focus here, where are we? We're in an inside bar, which means we're inside the range from the previous candle, but we're also over the previous candle high from November. So all this means is that we're digesting, we're consolidating. The quote that I used before, or the analogy, was we just ate a really big Thanksgiving dinner, and now we're wondering whether we want ice cream or apple pie, and we're full. So we can either unbuckle our belt, which is what the market did in December, right? Massive gains in November, unbuckle the belt in December, then we went higher, and now we're like, man, I don't really care how good that apple pie looks. I am just so full. We need to digest this move. That's what we're doing. So we're digesting below the all-time high, below the pivot, which would be the December high, and we're stuck between pivot number 2, which would be here for our July high or previous 52-week high at 459.44. Again, if you're looking for the high, it says H in the number as I hover over the candle. And then finally, we have a lower low. So until we print that lower low, what we want to be mindful of is that quote that we have here from Warren Buffett. Let me just pull that one up because I'm going to keep coming back to this over and over and over. The stock market is a device for transferring money from the impatient to the patient. We've been using this quote as it relates to waiting until we actually get a print below, meaning a weekly lower low. We went for 9 back-to-back weeks higher, and no one believed it after the second week, but we still went higher for 7 more. It's only been 2 here now, and what happens? No one believes it. Everyone's getting awfully bearish. So until we print that monthly lower low, which would be at 454.31, there's nothing for us to be concerned about on the monthly. Yes, there are warnings on the weekly. We talked about that. And now we're going to go through that a little bit more. So we got daily warnings, we got weekly warnings, but there is no warning on the monthly. So please be patient out there. Do not flip-flop like a flapjack. Have some conviction and stick to your guns. All right, there we go. So if now we think about that 454 or 455 area, I'm telling you that we see convergence around 455. Support is converging or meeting around 455. Our 50 DMA on the S&P 500 right now is curling up. So we can see the blue line here. This is the short-term price. It's the short-term support. It's curling up pretty fast. It will likely make it to 455 early this week as we go into that key data that I mentioned before. So we're going to have that 10-year note. We're going to also have the other economic data. So 453 is at the 50 DMA, and it's curling up, which means that 455 higher low should find very strong support. What should normally happen when we come down to a very strong support area is we at least get a dead cat bounce. If we fail to get a dead cat bounce, that is terrible. We do not want to see that if we are stock market bulls. This is what happened to Apple. Gapping crap, right? Massive gap. Massive gaps usually get bought up. A 50 DMA test, at least on the first try, usually gets bought up. That happened on neither scenario here. Gapping crap, continuation lower, and now we're barely bouncing off the 200 DMA. If we see this on the S&P 500, oh God, we're going to be quite bearish because I've already told you that when we look here to the annual level, we're already bearish. If we fall below 454, we're bearish on the monthly. We have more continuation. And when I talk about 378 here, yes, it's a little bit of clickbait, but here's the thing I want you to really understand. I'll take a second here to explain this because I didn't actually put it in my notes. So if we think about the annual level, we're going to zoom up weekly, monthly, annual. So when we talk about where support and resistance is, well, looking at this annual chart, under 470 is bad, but like where's support? Well, support would be right here at the 2020 high, which is at 378.46. And we already tagged that because last year we went down to 377.83. So we tested previous resistance and we bounced off that area. That's a dead cat bounce turning into a reversal. But now, if we look at the candle, the real body is like really far away. It's 100 points lower, basically. But we're not going to go down in a straight line. This annual chart is formed by 12 monthly candles. So I've told you that the only annual support is down here at 378 for a 12-month or 2024 level. But on a monthly level, I've just told you, 454. So right now for January, we've fallen below the monthly level to get bearish below 470. But support works like a staircase. We're not just going to go from 400 all the way down to 300 like a rock. That's sometimes it happens, right? It happened in 2020, happened in 2008, but we usually at least see short-term counter moves where we don't just go straight down. We'll go down, dead cat bounce, go down, dead cat bounce, go down, dead cat bounce, just like here. Down, bounce, down, bounce, down. So the monthly level is what we want to use as our guide. So we have support at 454 for January. If we take it out, then the next support's down here at 420. So again, not to get too ahead of ourselves, I think it would be unlikely for us to lose another 13 points this week. I could be wrong, but it would be what happened this week at negative 1.5% times 2. So if this week was bad, next week would have to be terrible for us to go down that much. Okay, very clear. 455 monthly higher low. And then the weekly early bearish confirmation. We went through that as well. So we're going to read the note now and try to understand what this means because it's telling us exactly what to look for next week. We got a warning because we got a failed breakout. We got early confirmation by printing that lower low, which is a potential trend change. We also happen to break our uptrend. That's bad because we stopped going up. So we were going up. Now we're going sideways. And now if we're going to go down, all it has to do is print this last candle here. It has to print 2 times lower lows to form a pattern and then close below the low. That's it. That's all we need to do. So we know exactly what we're looking for. 455 should be very strong support, but I showed you that example with Apple where it could actually not happen as well. I'm going to start going through a little bit faster because we're now at the 20-minute mark. But again, please make sure you subscribe. I'm going to go through all the stuff on the pre-market streams at 9:15 Eastern every single day. So now for the QQQ, we note that the annual level is now bearish. So again, below, we're going to go here to 1 month higher, QQQ. Same thing. Below 400 is bad, right? So good over 410, bad under 400. We're under 400. That's bad. Okay, simple. So we're bad. On the monthly, exact same thing as the S&P 500. So if now we go here to our monthly chart, we have, and let's actually go to, here I have do I have another note for QQQ? 1 second here. Oh yeah, here we go. So we've actually back tested. I'll talk about that on the weekly chart. So we got 2 pivots here. We got our high, we got our low. We got about another 16 points for us to go down to support. And we got roughly another 16 points to form a higher high. What does that mean? We're exactly in the middle. 16 points to go up, 16 points to go down. I would not call that bullish or bearish. I would call that neutral, which is exactly what we have here. We're neutral. We're consolidating after a really big Thanksgiving dinner. On the weekly chart, we have early bearish confirmation. Oops. So that's the same note that we talked about on the S&P. We got a failed breakout on the week of December 26th. We got the lower low and closed below 407 this week. All we need for next week is closing below that same thing. That would be a close below 395. Really simple. All right. And now on the daily chart, what do we have? Well, sorry, on the weekly, we also got pivot 1 tested at roughly 395. That's going to correspond with our November high. So we got a test on the first pivot. If this one does not hold, we should be looking for a test right back down to December next. The NASDAQ's likely going to fall first because the NASDAQ leads the S&P 500. So if we lose this pivot at 395, 394.14 to be specific, it's likely going to drag the S&P down to that 355 area. And then finally, same thing as the S&P, the 50 DMA is curling up awfully fast, and it's going to find that support for us right here above our monthly higher low. So if we lose that low, again, right here at 382.66, if we now come back here, if this 50 MA is now over it by closing below the 50, that would be our bearish confirmation, just like SPY. Exact same chart, exact same setup. Okay, very simple. We talked about the 10-year note. We talked about the dollar. Now let's talk about volatility. So volatility is now into the lowest teens. This means that if you are a scaredy pants or if you're worried about your portfolio, don't sell everything, which, again, I'm not a financial advisor. I can't tell you what to do, but maybe instead you want to buy some insurance. That was the theme of a lot of our videos this week, buying insurance like a house. You don't not buy a house because you're scared it's going to burn to the ground. What do? You buy some fire insurance. Scared there's going to be a flood? Well, you can buy the house. Just buy some flood insurance. There you go, right? There's always going to be things to be scared about in life. If you're scared, buy some insurance. Buy now because now is when it's cheap. So you buy it when it's cheap, not when it's expensive. And then finally, the Magnificent Seven. We talked about Apple earlier this week, and we talked about how it's already in trouble because if we go here to our annual chart, Apple is now flashing a bearish signal because it is below both the 2021 and 2022 highs, which is giving us a fail for right now. So we could come all the way back down to roughly 130 or lose $50. Again, I know these are really big numbers, but we have to be ready for what the chart tells us. Not what we want to see happen. Man, I don't want this to happen. But I'm not going to be surprised if it does now because I've laid out my roadmap. So finally, if you want to watch more about my 2024 predictions or what I thought for the monthly level, that's now queued up here on the left-hand side. If not, consider subscribing to the channel on the right-hand side. I will be streaming live at 9:15 Eastern on Monday to give you more notes and context on this weekend update. Thank you very much for tuning in. I appreciate your support.